Hello, I'm Jeppe Kirk Bonde, popular investor on eToro.com. So since 2013, I've delivered over 33% average annual return on investments. And for that reason and others, more than 20,000 people are copying my investments on eToro for close to 70 million US dollars. So in the news recently, many people have had various worries, including on inflation, interest rates, the energy crisis, supply chain bottlenecks, China, Evergrande, COVID, and I thought I'd just give my perspective on each of those things in turn, and then finally talk about my total economic outlook. So, firstly, regarding inflation, I think it's important to understand that in the past 5 years, the total money and credit supply in the US has been expanded by 5% per year. So, if you have an economy that's growing its goods and services, transactions, and so forth by 1% per year, and there are certain factors, including innovation, that can drive price declines of about 1% per year, then that sort of leaves you with a long-term inflation expectation of 3%, or at least 3% upwards pressure on prices. And sort of Goldman Sachs has recently forecasted that we will have inflation in that sort of ballpark area in the medium and long term. And that sort of means that, of course, you'll have to have some kind of tapering to bring us down at least reasonably towards that 2% average goal that is the official goal of the central bank. And whether or not we'll have inflation of 2% or 3% or even 3.5%, it sort of means that cash isn't king. You're going to be losing out to a small extent or a high extent from having cash on average. Then in terms of energy prices have increased by 9% per year for the past 5 years. There's a good McKinsey report that gives their forecast for how the energy mix will change over the next 3 decades. And the sort of main conclusion from that report, from my perspective, is that one of the smartest companies in the world, with some of the smartest people, concludes that we will not at all really meet our goals to stop dangerous climate change. And that's, of course, very unfortunate. In terms of my portfolio, we are quite energy independent, with a disproportionately high amount invested in solar. And also that McKinsey report does predict solar as the one that'll grow the highest as part of the energy mix over the next decade. So that sort of makes good sense. In terms of supply chain bottlenecks in the economy, during the COVID period, there's been lots of companies obviously afraid to overinvest in logistics capacity, inventory, and many other factors because their future was uncertain. And now, with individual companies being understaffed here and there, maybe one of the suppliers is temporarily shut down because of COVID. You might have a key employee who's needed for a decision, but he's sick, and then you suddenly have lots of pent-up demand that's way more than what your logistics capacities were ever really built to handle. And then that can give you sort of a disruption. But if that disruption is really only for 1 to 2 years, then it shouldn't really be a big factor in terms of your company's total value. Some companies with high growth, more than 75% of their value is in cash flows that will come 20 years from now and beyond that. So then whether or not you have slightly higher or lower profits in the next 1 or 2 years really isn't that big a deal. And if there are some things you can do that will help you in the short term, that will also give you a long-term benefit for a company, then that's great. But it's certainly not necessarily good to go out and overinvest in something that will increase profits for 1 to 2 years, but then sort of when things return to normal or to the new normal, that you might have some overinvestments there that won't be worth as much. In one of the sort of bottlenecks that's been talked a lot about is semiconductors, and I do have some semiconductors in the portfolio to sort of mitigate that to a certain extent. In terms of COVID, I think the idea of the reopening play is not really a good one, for the same reason that I just mentioned with the supply chain bottlenecks. You might get a boost in profitability for 1 or 2 years, but that's not really the key driver of the value of the business. It's the long-term things that really matter. And currently, 40% on Earth or more have had the vaccine now, and we've built the production capacity to have everybody vaccinated twice within 14 months. So of course, some people don't want to be vaccinated. I've had the Pfizer-BioNTech vaccine twice, and that should decrease my risk of getting severe COVID by a factor 5. So based on their own numbers, which are not distorted by confounding variables or anything. So that's obviously quite nice. I think sort of whether or not people will get a vaccine once per year going forward, or will choose to deal with it in one way or the other, it's fair to say that we're going to have higher costs for healthcare. We're going to have more investments in security. We're going to have more surveillance, and we're going to have less freedom. And that's the future with COVID or not. And I think you might as well start building your lifestyle and portfolio around that. And I'm not saying that's good. In fact, it's quite clearly bad, and just sort of being realistic about that. Then in terms of China, Evergrande, the Chinese property developer, construction company, and real estate company, they have liabilities of $300 billion and won't be able to repay borrowers their due interest. And I reviewed Chinese construction companies. I've reviewed them for many years, including China Evergrande, looking at video footage of ghost cities and evaluating these extremely high debt equity ratios. Some companies have had some individually really nice assets that I would have loved to invest in, but because they've been part of these larger, not quite terrible companies in my view, I've not invested. So those are not to be found in my portfolio, and neither are, for instance, some of their larger lenders. And if you sort of take China Evergrande and 10 similar companies, then their combined liabilities are really only $2 trillion. So while this is something bad in this industry is really bad, but it's certainly something that the Chinese government and the Chinese central bank have more than enough firepower to deal with. So this idea that this is like a Chinese Lehman Brothers moment or something like that, I think is really not the case. Then finally, if you take my total economic outlook, then I think there are stronger factors at play than these mentioned worries that can drive future profitability and growth, and therefore the value of companies. And especially machine learning, robotics, and the quick spread of global best practices. If you travel the world a lot like I do, you'll see different people in different parts of the world doing small things slightly better. And that might just be because they've joined some group on Facebook where they're suddenly seeing, oh, you can do this in a slightly better way, and that drives growth. And there are some companies that have really, really high growth and very high profits, and not just that, but they have sort of the kicker that they could come up with new world-changing technology. And these I think are really amazing to be invested in right now. So I think if someone's holding lots of cash and lots of gold, sort of hoping that maybe they can enter the stock market at a later stage, then it's more likely that they'll regret it and look back and say, oh, I wish I had invested more in these amazing companies earlier.